Welcome to this short executive knowledge lecture on topic 6, paper 7 of the SFC licensing exams. This topic covers financial risk management, and we'll be looking at what is risk. We'll contrast risk with expected return. We'll be looking at different types of financial risks, the risk management process, and we'll finish off with looking at financial risk management in Hong Kong. I will emphasize the important points to help you understand the core material you need to know to sit the exam, and a copy of the study notes that you see on the screen can be downloaded from the Executive Knowledge website under Paper 7 resources. Now, I strongly recommend that you supplement this learning with question practice, and we've uploaded over 300 practice questions for Paper 7 across all 7 topics on the Examinator.online platform. So we start at the top of page 2 by asking the question, what is risk? Well, risk is the risk of losing something, pure risk, the loss of physical assets, financial risk, the risk of financial loss relating to business activities. Risk versus expected return. Now, when we're looking at an investment and we expect a return, it can vary from being a return that is highly predictable to being a return that is not so predictable. Now, if it's highly predictable, then it is not going to vary much. And we say that the risk is low, the risk of it moving away from the expected return. But if you want a high expected return, which is further away from the expected return, there has to be a higher degree of variability in the returns. And we measure that by risk, and we'll see later that is measured by standard deviation. So it goes that to enjoy a higher return, you have to take on more risk. That is the possibility of higher variability in returns. And we'll be coming back to the risk-return relationship very shortly. Now, different fundamental risk management techniques. We have 4 listed at the bottom of page 2. Risk avoidance, that is where you just don't take the risk on at all. Not going into a particular line of business because there is a risk of losing money, that is risk avoidance. Risk reduction is where you expose yourself to the risk, but you reduce potential loss. And foreign currency hedging is a classic example of risk reduction. Risk transfer, that is where you transfer the risk of loss to another party, usually an insurance company. So insurance policy is an example of risk transfer. And risk retention is where you're happy to expose yourself to the risk. Foreign currency markets are a classic example. If we reduce the risk by taking out a forward currency contract, then we're locked into a particular rate. But if we leave ourselves open, then there is the possibility of gaining as foreign currency rates move, but you also expose yourself to loss. Now, we have different types of financial risks. This is one page, and this is one page worth knowing. I reckon that you're going to have at least 2 questions from this page in the exam. So the financial risk can be looked upon in 5 ways. Credit and settlement risk. Credit risk is the risk of not being paid by a counterparty, and it's also referred to as counterparty risk. Settlement risks, similar but slightly different. The risk that the transaction does not settle as intended when you expected. So if you are expecting transaction to settle and you're going to receive money, for example, and it doesn't settle on time, that could give you cash flow problems. So credit and settlement risk we bind together. Now, market risk and basis risk. Well, market risk is the main one. That is the risk of losing money because the market goes against you, unfavorable movements in market prices. And those market prices can be in terms of stock prices, interest rates, currency rates, and commodity prices. So those are all types of market risk. Basis risk is to do with the linking of derivative and underlying asset prices where they become unaligned. I wouldn't worry too much about basis risk. Liquidity risk is the risk of losing money because you're unable to sell into a market at a fair market value due to the shortage of buyers. So an illiquid market gives rise to liquidity risk. Operational risk is where you risk losing money from failures or faults in your processes, procedures, trading, or settlement systems. Now, there are other risks, and these have been examined at paper 7. Legal risk, that's where you risk loss from unenforceability of contracts. So you go into a poor contract, it's not well written up and it's difficult to enforce. That is legal risk. Reputational risk is the risk of loss, losing money from reputational damage. So if you have a factory and the factory is fined for pollution and customers don't like that concept, your reputation is tarnished, you may lose their business. Reputational risk is examined. Strategic risk, fancy way of saying you have no plans, risk of loss from implementing or indeed not implementing new initiatives or strategies, and systemic risk, that's on a bigger scale, the risk of loss from a breakdown in an entire system. The clearing and settlement system of the securities market breaking down would be an example. Okay, we move on to the risk management process, and we are going to start with identifying risk. We'll move on to measuring risk. Then we'll consider the management of risk, and finally, the monitoring of risk. Now, identifying risk in a business is all about understanding the business. And we've seen examples of management not understanding the business and losing big time as a result. And the bearings case, which we will cover towards the end of topic 6, is a classic example where the senior management of the business in 1995 just did not understand the world of futures trading. Once you've identified the risk, you want to measure the risk. And risk is measured using the mathematical concept of standard deviation. What is standard deviation? Now, you're not going to need to know in depth the mathematical structures that we're going to go over, but you do have to have an awareness, and the questions should then be doable. Standard deviation technically is the square root of the variance. So we're going to have to calculate the variance. What is the variance? We will do that very shortly. As it says there, we get there by applying probabilities to different possible returns in relation to expected return. That's a bit of a mouthful, but we're going to do it step by step. The first thing we're going to do is calculate the expected return of an investment. And to come up with an expected return, you have to have some idea of the probabilities of different returns. So we'll do this by way of an example. Dead Certainty Limited has the following return probabilities for the next year, and you're asked to calculate the expected return. Well, it's a weighted average calculation. So at the bottom of the page under solution, you will see that we take each of the probabilities, 30%, 50%, 20%, and we multiply them against the return. Now, when you do these calculations, you don't take 30 multiplied by 4 and get 120. No, one of them has to go to decimal. So probability 0.3 multiplied by the return of 4%, that is 1.2%. So we're weighting each of the expected returns, or the possible returns, I should say, by the probability of them occurring. So expected value, 1.2, 4%, 2%, we add them up. The expected return, the weighted average return for Dead Certainty Limited is 7.2%. Now, going on to calculate the variance and therefore the standard deviation, because as I've said, the standard deviation is the square root of the variance. Let's look at two companies now. Well, the first one we've already introduced, Dead Certainty. Middle of page 5, there is the probabilities of the different returns. We also introduce good chance with 3 other probabilities of 3 other returns. Let's look at dead certainty. Well, we've already calculated its expected value. And the variance is a measure of how much each possible return varies from the expected return. And you can see the formula top right of that table. It is the probability of each return multiplied by the difference between the return that's possible and the expected return, which we've already calculated 7.2. So you're looking at the variation around the mean. Now, R minus ER, if you look in the first example or the first line, R is 4% and ER is 7.2%. That means 4 minus 7.2 is minus 3.2. Well, when we're doing these calculations, the minuses would cancel out with the pluses and would be going nowhere. So we have to eliminate the minus element, and we do that by squaring. So that's the reason we square what's in the brackets. So for the first row, I would take the probability P of 30%. Now I do everything in decimal in this calculation. So 0.3 multiplied by open brackets, 0.04 the return, minus 0.072 the expected return, and I square that. If you hammer away on the calculator, you will get 0.0003072. I carry out the same calculation for return of 8%, return of 10%, and then I add the 3 terms up and I get the variance. There is the variance, 0.000496. What does that tell me? Not a lot, although you can compare variances across different investments. But to make sense, we have to revert back to the original measure because we squared it. So by squaring it, it becomes distorted. So we take the square root to get back to percentage. So the square root of 0.000496 is 0.0223. Now we're in decimal format, put it back into percentage. The standard deviation is 2.23%. So what we're saying is that dead certainty has an expected value of 7.2% with a measure of variation around that expected value of 2.23%. I wouldn't worry, we're not going to go into probability tables for different standard deviations. That's beyond this paper. But you have to appreciate the difference between a company with a high standard deviation and one with a low standard deviation, which takes us on to the next example, which is good chance. And we do the same calculations. Good chance had different probability distribution across 3 returns. We calculate the expected value, and you see that it turns out to be 8.8%. We do the same calculation of variance, and that comes out at 0.004416. We take the square root, and we end up with 6.65%. Now, the important point here is the comparison. So you can see that dead certainty is an expected return of 7.2%. Good chance has a higher expected return of 8.8%. So surely good chance is more attractive. But what about the risk? You can see the risk of dead certainty is much lower. It's a lower standard deviation of 2.23, whereas good chance has a higher standard deviation, a higher risk measurement of 6.65%. So even though you're predicting a higher expected return of 8.8%, that can vary by much more than dead certainty. So the conclusion, good chance compared to dead certainty has a higher expected return, but a higher risk, and that is very common. Now we can show the risk return profile by way of a normal distribution curve. And you can see this is not the 2 examples we've just looked at. This is separate security X, security Y. Now the expected return is in the middle. and the variability of the possible returns is then plotted. And you can see that security X, the possible returns are much more tightly organized around the expected return. The dispersion is low compared to security Y. So what is our conclusion? The lower standard deviation of security X means the likely returns are more tightly clustered around the expected return, whereas security Y with a greater standard deviation is riskier because the returns can potentially move way off to the left, and that is not good news for an investor. So measuring market risk. It's a number of market risk measures. Be aware of these. We have value at risk, stress testing, duration, dollar value per basis point, and option sensitivity measures. Now, we provided the notes on each of these. The ones that I'll just spend a bit of time on is duration. Now, duration is to do with fixed income securities, bond prices. And duration measures the sensitivity of the bond price to changes in interest rates, taking into account the bond's yield, maturity date, and coupon cash flows. Now, points to be aware of. Duration approximates to the percentage bond price change for a 1% change in interest rate. The higher the yield, the lower the duration, so the lower the variation. The greater the time to maturity, the higher the duration. So the longer the term to redemption of a bond, the more chance the price will move to a change in interest rate. And the higher the coupon, the lower the duration. That can come up at paper 7. The measuring of credit risk, the risk of not being paid. Well, that's measured either internally by credit analysts in particular companies, and indeed credit controller can be looking at different customers and the risk that they pose in terms of non-payment, or externally, and this is the world of bonds, by credit rating agencies, and we will consider credit rating agencies a little later. Now, to measure liquidity risk, that is not achieving what you expect the market value to be because of lack of buyers, that's measured by identifying gaps in an organization's future cash flow, and that enables costs of funding liquidity shortfalls to be determined. What that means is you do a cash flow forecast, you look at potential shortfalls, and then you organize the funding of such shortfalls. Now, the third stage after identifying and measuring risk is managing risk. And we are given the necessary attributes of a financial risk management system, which often is examined. So please be aware. Attributes of a strong risk management system include comprehensive supervision, appropriate technology and training, a liquid derivatives market enabling you to hedge, and clearly documented policies and procedures. Now, though some of those may appear to be slightly bland, but please write them down and be aware of them because they like to test you on that. Effective risk management includes reliable and independent pricing systems, accurate risk measurement, appropriate price limit setting, segregation of duties, compliance with regulatory requirements, and adequate internal and external audit policies. And again, they could set you a question asking you which of the following are effective risk management procedures. And finally, the fourth step is the ongoing monitoring of risk. There should be a continuous process of reviewing your risk management systems and processes, and there are firms available that provide risk management services, from computer software to professional advice.